JBlog, 6th of December 2009. Had some interesting action on Friday. I'm still trying to figure out exactly what it means. I mean, I know what it means. I'm just wondering whether it will carry on. But basically what happened on Friday is a positive employment number came out. At least the market thought it was positive, and now the market is worried that if the economy is actually doing better due to better employment picture, then perhaps the 0% interest rates that have been in effect for 2009 will be cancelled. Interest rates will go up, which will cause the US dollar to go up in price because currency exchange is mainly dictated by interest rates. Very little else matters to um, currencies on a big picture basis. So the announcement drove up the value of the US dollar on Friday, which then in turn tanked the market. Um, One thing that I was looking at, I just came across, is this long-term trend that I drew that started um, just when the market started dropping in the fall of 2007 and went up here and then had the horrible drop in late 2007, another drop, and it's been rising, one, two, three, a slight violation here and continuing violation of this trend up. So I drew a second trend line. This one seems to be holding a little bit better. We'll see what happens, but the interesting part is that once this rally um, touched this descending trend line, it did not go any further. So from that point of view, we could still very much be in a bear market, and this could just be a bear market rally. If we take a closer look in the 3-month chart, we see just up here the line that comes down that capped this rally, possibly, maybe. We'll see how it all continues. It will all depend on basically the US dollar. Here's the US dollar chart for Friday, and here's that big bounce. This is the biggest candle we've seen in quite a long time, basically since August, the strongest up day. Now if this continues, then that would basically take the wind out of the sails of the bulls and tank this rally. This rally, which I believe has gone way too far, way too long, and there's no fundamental justification for it being where it is. But it's basically driving on liquidity, the US dollar carry trade, where people borrow in zero interest US dollar and they sell the US dollar short, and they're buying everything else. They're buying assets, they're buying real estate, they're buying stock market, they're buying foreign currencies. Everything has been driven up in the last little while by this, but that could very well come to a very abrupt end. There are some very interesting other developments that are going on. I'm just gonna switch over into a currency chart over here. If I can find it, currency chart, here it is. Looking at some of the other currencies, for example, the Australian dollar, which has been a strong recipient of this, is showing a lot of volatility here lately towards the end of the run. There's some uncertainty here. The British pound is showing a huge amount of uncertainty here. The Canadian dollar is not so uncertain. It's based mostly on the price of oil. But then we have the euro. The euro had a big down day on Friday, and seeing that the euro is the main exchange, main other currency against the US dollar, if this very extended euro rally is over, and there could very well be that, considering the problems in Greece and with some of the other euro countries, then the US dollar would be forced up because people would be escaping the euro and other currencies. Now going other developments. One of them is the VIX. The VIX indicates total complacency, no fear whatsoever. People are not buying insurance against a possible drop. That is interesting. I would be worried at this point, but then I'm have been very cautious for quite a while. There was a massive day on Friday. A lot of it went into the financials. Lots and lots of volume on Friday. Um, One thing that I've been looking at now a little bit is utilities. Utilities are going up. It could be another destination. Instead of people going into bonds, people going into the utility stocks. They have a pretty decent dividend return, and they would stay up with inflation. If it were to happen, um, of course, the smaller stocks are not reacting to all of this liquidity because the liquidity is heading straight into the major stocks, the S&P 500, the Dow Jones. That's healthy. You look at the Russell 2000, you look at the mid cap, and those are weak. This is another way of looking at that same thing that I just said. This is the bullish percentage index of how many of the S&P 500 stock charts are actually bullish. This is going down, which means that the rally is continuing to be carried by fewer and fewer members, and sooner or later those members will get tired and they will fall down. Here's the mid cap, it's not looking so strong. Here's the Russell, it looks awful. But the market continues going up. A few other things I've come across. Here is this is the value line arithmetic index, which is basically the S&P 500 stocks, but arranged in different quantities in a different way. Accounts more for it tries to ignore some of the bigger stocks and looks more at the broad market. Again, it's telling us the same thing as the bullish index, that lots of the smaller stocks are falling down, are collapsing. Very interesting. Here's a chart of the US dollar. There's some other stuff coming up. Here's the big issue is coming up. FAS, Federal Accounting Standard 167. You'll be hearing a lot more about that come next year. It basically forces banks and financial institutions to take more of their bad debts that they have hidden away in some off balance sheet places and take it onto their balance sheets. It will reduce the financial health of, or the accounting value of banks, and therefore could hit stock prices quite significantly. So that's something that's coming up. Commercial real estate is still going down, and there is trillions of dollars tied up in that. So that's another thing that's going to hit us in 2010, on top of continuing prime and option arm mortgages, which are not looking too hot neither. All in all, employment picture, yes, the number looked good that came out on Friday, but it only looks at U4. It does not look at U6. U4 is a very limited view of unemployment. U6 is much broader standard. According to U6, the unemployment rate in the United States is over 17% rather than 10%. That includes people who are underemployed, i.e. people who don't have a lot of money on their hands right now, and that's what that's supposed to tell us. So I wouldn't worry too much about full employment coming anytime soon. But my 10 minutes are up. Hope you're going to make lots of money. I continue being bearish. I'm long the US dollar. I'm short the stock market, and I'm happy there. So good luck next week. All the best.